Hello and welcome everyone. My name is Yasir Gulfraz and today we will discuss our lecture 4, uh, which is Finance for Strategic Management, Finance for Strategic Managers. So yesterday we discussed key concepts of financial management and cash flow. So anybody can see my screen if anyone is there? Or can you hear me voice? Okay. If there is any issue, please do let me know. So I'll check it for you. So yeah, what I was saying that yesterday we discussed key concept of financial management and cash flow. We will various types of expenditures, investment, appraisal techniques, long-term and short-term. We discussed yesterday types of expenditures, investment, appraisal techniques, long-term and short-term finance, sources of finance, and cash flow management. So today lecture is about aims. Today's lecture's aims and objectives: introduction to investment, appraisal, discussion or IRR and break-even point. So explanation of budget and cash budget. Objectives: learner will be able to discuss the IRR and break-even point, describe what is meant investment appraisal, define what is meant budget and cash budget. So it's a quite long lecture, but I will try to finish. If not, then we will split in 2 parts. So let's get started. So good afternoon, everyone. Today we have an exciting topic to discuss, a part of our extended diploma in management course, and the subject is finance for managers. So what do we know about IRR breakdown? Anybody can tell me, or if anyone is there? So appraisal, exploring concept such as internal rate of return and break-even point. Additionally, we will explore the significance of budgeting and cash budgeting, the realm of management. So let's start with understanding the aim of today's lecture. By the end of this session, you will be able to discuss the IRR and internal rate of revenue and break-even point, describe what investment appraisal means, and define both budget and cash budget. These objectives will provide you with a solid foundation in financial management and decision making. Background knowledge: what do we know about IRR and break-even? So internal rate of revenue and its relationship with the break-even point. The concepts plays an important role in assessing the viability of investment projects and helping businesses make informed financial decisions. Internal rate of revenue here, IRR or internal rate of revenue, internal rate of return, sorry. So internal rate of return is an alternative method of the net internal rate of revenue rate of return is an alternative method to the net present value method for evaluating investment opportunities. While net present value determines whether an investment yields a positive or negative net present value when discounting at a specific interest rate. Interest rate of return goes on step further by determining the actual rate of return on an investment. In simple terms, the IRR represent the discount rate at which the net present value of investment becomes zero. If the IRR exceeds the minimum acceptable rate of return set by the company, the project is considered viable. For example, if a company only accept project with a rate of return over 15%, any project with the and IRR greater than 15% would be deemed feasible. Any questions? So here is an example, a project costing £800 in year 0 is expected to earn £400 in year 1, £300 in year 2, and £200 in year 3. So calculate the IRR. So this is the calculation of IRR example. Let's consider an example. So suppose we have a project with an initial cost of £800 in year 0, expected cash flow 400 in year, 300 in year 2, and 200 in 3. So we can calculate the IRR estimating the interest rate of which the NPV is close to 0. Here is calculations. So I'll try to explain in my own words. So try to calculate here. So to estimate the IRR, we need to find two interest rates, one that yield a small positive net present value and another that result in a small negative NPV. So the IRR will lie between those two rates, above the interest rates where the net present value is positive, but below the rate when the NP is negative. So to identify these interest rates, we can utilize a simple estimation formula. We will calculate the approximate IRR using the following formula. So IRR is equal to 2 multiplied by profit divided by cost of the project. So total profit over 3 years is £400. Here the profit, so that's a £400 plus 300 plus 200 and minus 800 is equal to 100. So an approximate IRR is 2 multiplied by 100, 0.08 approximately. So 8% is the starting point of 8%. So net present value at 8%. Yeah, here. So approximately IRR is to, yeah, we calculate NPV at 8% interest rate to narrow down the range. So at 8%, the NPV is negative minus 13.7, including the project does not earn 8% or higher. So here the NPV is negative, and so the project does not earn 8%, and so the IRR must be less than 8%. So net present value at 6%. Calculation is here. So at 6%, the net present value becomes positive, which is 12.2%, showing that the project generate return higher than 6%, but lower than 8%. So here is the formula, which is now work out the exact IRR is equal to A percentage plus A divided by minus B. So B minus multiplied by B minus divided by. So A is the lower interest rate, B is the higher interest rate, A is the net present value at rate A, also B is the net present value at B rate. So final answer will be, we can use formula to determine the exact IRR is equal to 6% plus 12.2 divided by 12.2 plus 13.7 multiplied by inverted bracket 8 minus 6 inverted bracket percent. So 6% plus 0.471 multiplied by 2, 6% plus 0.94 2 multiplied by percent, and then 6.942% approximately. So approximately IRR is 6.942% or 7% approximately. What is budget? Anybody can tell me what is budget if anyone is there? Okay, a budget is a plan expressed a financial or other quantitative terms which extends forward for a period in the future. So budgets in the integral part of financial planning and control. They are formal plans expressed in financial or quantitative terms that extend forward for a specified period, typically 1 year. So budget assist businesses in align their strategic objectives with detailed plan, allowing for better resources allocation and performance monitoring. So now we will discuss different types of budget with their name will come here now. Budgets will define, precise targeted concerning cash receipts and payments, sale, detailed stock requirements, detailed labor requirements, specific production requirements. So the reason of producing a budget, obviously, we produce budget because of planning, coordination, communication, motivation, control, and evaluations. So basically, budget help organize, set financial goals, and allocate resources effectively. They provide a roadmap for achieve desired outcomes. The horizon budget is an essential financial management tool that helps businesses plan and allocate resources effectively. It involves estimating and allocating funds to various activities, departments, or projects within organizations. Businesses typically prepare budget on an annual basis due to several reasons. The term horizon aligns with the strategic objectives of the organization, ensuring that financial plans support long-term growth and development. Annual budget also allows companies to adapt to changing market conditions, evaluate performance, enhance accountability, and facilitate collaboration within the organization. Businesses can effectively manage their resources and navigate the dynamic business landscape to achieve their financial goals or objectives. Targeted annual budget set targets for the year for all level of businesses, and usually broken down into monthly budget, which define monthly targets on quite after the annual budget is created from monthly figures. Budget and forecast. Budget is plan, not a forecast. A plan is an intention to achieve a target, whereas forecasts tend to be prediction of the future environment. So forecasts play an important role in their development. Forecasts are prediction of the future environment and can provide valuable insight into potential opportunities and challenging. So budget is and forecast in achieving targets by, when a business operates without a budget, it lacks a clear direction and may struggle to allocate resources effectively. So by setting specific target within a budget, businesses provide a framework for decision-making and resource allocation. It enables management to prioritize activities, allocate funds, and measures performance against predetermined goals. Periodic and continual rolling budgets. So the different time horizon for budgeting: periodic and continual rolling budgets. Periodic budgets are prepared for a specific period, usually 1 year. They are one-off exercise that is agreed upon and then allowed to run its course. Any necessary amendments are made as the budget period progresses. In other hand, continual rolling budgets, on the other hand, are continually update each month. A new month added to the budget, and adjustments are made based on actual performance and changing circumstances. Continuous budget provide a more dynamic and flexible approach to financial planning. Here is activities. You need to tell or you need to discuss about advantages and disadvantages of each form of budgeting. So periodic and continuous. So if I say simply that, periodic budgets offer the following, offer the period budgets are relatively straightforward to create since they cover a fixed period and require a one-time planning exercise. With a fixed budget period, businesses can work toward a predetermined target without frequent changes. But periodic budget also have some disadvantages, limit adaptability, reduced agility because may miss opportunities for fail to respond effectively to market changes due to the rigid nature of periodic budgets. Continual budget advantage of continual budgets, they allow for more ongoing adjustment, enabling businesses to respond quickly to changes in the market or internal circumstances. Improved accuracy, continual budget benefits from updated information, leading to more accurate forecast and planning. They also have some disadvantage, complexity. Continual budget requires ongoing monitoring, analysis, and adjustments, which can be time consuming and resource intensive. Potential loss of focus, continual budget may lead to excessive time spent on budget revisions, diverting attention from other critical activities. Any questions so far, if anyone is there? Okay, interrelationships. For any one period, there will be more than one budget, and each one will relate to a specific aspects of the businesses. So all these budgets can be summarized into master budget, which usually consists of a budgeted profit and loss account, balance sheet, and sometimes cash flow statements. Simple example, here we will discussing the interplay between various budgets within a business and how constraint on the sales target can impact the achievement of other budget. In particular, we will explore the sales budget, stock budget, production budget, purchase budget, and cash budget, and understand how they are interconnected. So first, for most market conditions and customers deemed can significantly impact to achievement of the sales target. Economic factors such as inflation, exchange rates, and consumer confidence can influence purchasing power and consumer behavior. Additionally, factors specific to your industry, such as competitions, pricing strategies, and shifting in customer preferences can also affect sales performance. When the sale budget falls short of expectations, indirectly impacts the stock budget. The stock budget outcome the desired inventory level of support sales and meet customer demand. If sale projections are not met, excess stock may accumulate, drying up valuable resources and potentially leading to obsolescence or storage cost. Insufficient stock can result in missed sale opportunities and dissatisfied customer. So here is a what concentrate might be there be an achievement of the sales target, and hence the target budget involves. So again, that sales budget, he's talking about that production department within your organization are directly affected by stock and sales budget. So to achievement of sales target, and hence production budget needs to be adjusted accordingly, avoid overproduction. So when the sales budget falls short of expectations, indirectly impact the stock budget. So the stock budget outlines the desired inventory level to support sales and meet customer demand. So if sales projections are not met, excess stock may accumulate, so tying up valuable resources and potentially leading obsolescence or shortage costs. Budget setting process. Importance of the budget setting process and its impact on various aspects of an organization's operations. Budgeting plays an important role in ensuring the efficient allocation of resources and achieving the overall objectives of our business. To approach budgeting in a logical and methodical way. So we need to follow several steps to achieve the budget setting process together. Just give me a second. Yes. So establish who will take responsibility for the budget setting process. So it is essential to determine who will take responsibility for the budget setting process within the organizations. Those assigned this responsibility should have the necessary necessary authority to make decisions and implement the budget effectively. In some cases, a budget committee consisting of senior members from each department, often including accountants, is formed to oversee the process. Communicate budget guidelines to relevant managers. This is a step 2. Communicate budget guidelines. Once the responsibility is established, it is important to communicate the budget guidelines to the relevant managers. Managers need to understand how their budget contribute to the achieve of the organization's long-term plan. The budget committee plays a vital role in ensuring that managers comprehend the operating environment they will be working in and are aware of any restrictions or limitations that may impact their budgets. Any question, if anyone is there? Any question about communicate budget guidelines to relevant managers? Okay. So number 3 is identify the key or limiting factors. Identify the key factor. Identifying the key factors, also known as the limiting factors, is an essential step in the budget setting process. This factor is often related to the sales budget, as the ability to sell products to services is frequently limiting factors that cannot be easily overcome. Limiting factors can include constraints such as cash availability, labor resources, or the availability of raw material. Then next is prepare the budget for areas of the limiting factors. Prepare the budget for the limiting factors. Once the key factor is identified, the budget for area of the limiting factor is prepared. This typically involves the sale budget, as it set the foundation for other budgets. Since forecasting future sales can be challenging, organization must employ various techniques and data analysis to estimate sale accurately. Next one is prepare draft budget for all other areas. Draft budget for other areas. After preparing the budget for the limiting factor, it is necessary to develop draft budgets for all other areas of the organizations. These budgets should implement the budget for the limiting factor and align with the overall objectives of the business. The budget committee plays an important role in reviewing and adjusting these budgets, ensuring they are realistic and achievable. Negotiation may be required to reconcile any discrepancies or a conflicting requirement between departments. Next is review and coordinate budget. So this step involves reviewing and coordinating the budget to ensure consistency and compatibility. The master budget, which typically include the budgeted profit and loss accounts, budgeted balance sheet, and possibly a budgeted cash flow statement are derived from the individual budget. The budget committee is usually responsible for the process, ensuring that all the necessary information from the various budget is integrated into the master budget. Then step 7, prepare the master budget. A master budget with all the data in place, the master budget are prepared. These comprehensive budget provides a holistic view of the organization's financial positions and operational plans for the upcoming period. A master budget serves as a roadmap for decision-making, resources allocation, and performance evaluations. Then is talking about communicate the budget. So the formally agreed budgets are now passed to the individuals, managers who will be responsible for their implementation. This is senior management communication to other managers the target must achieve. So when what can go wrong at this stage? Monitor performance relative to the budget. There is no point creating a budget if actual performance is not compared to them. Here is a seminar or activity, discuss the benefit and drawbacks of budgeting. Research the following types of budgeting and identify what makes them unique. And budgeting is also so important. It must be approached as a logical and methodological way. Discuss how this may be achieved. Okay. So any idea about advantage and disadvantage of budget? Anyone can? Okay. So basically budgets, allows managers to plan ahead. The biggest advantage, allocate resources effectively and improve communication and coordinations. So, but there are some disadvantages as well. The main is delayed result. Budgeting requires obviously time and work. So as you are aware, and there's some individuals, the reward don't show up quickly enough. So it can be inaccurate, stressful process, or budgets is rigged, and budget result takes time to appear. Variance analysis is difference between planned budgets or standard cost and actual cost, as well as in respect of revenue. So variance ARF reasons, materials price, materials usage, labor rate, labor efficiency, fixed overhead, expenditures variances, fixed overhead, volume variances, fixed overheads efficiency, and fixed overhead capacity variance. Next one is variances in the profit and loss account. Variances can also be caused in different parts of your budget. Three most common parts are sales, direct cost, and indirect costs. So calculation of labor variances, actual hours, actual rate, actual hours, standard rate, standard hours, standard rate. So here is efficiency variances this side and revident direct labor total value of underlying root cause of variances. So variances analysis, a company make cabinet and the deluxe model has the following labor requirements: direct labor per cabinet 4 hours times 7 per hour is equal to 28. This is shows direct labor mean cost, and during the current month it manufactures 1200 cabinets. The sum as its budget, the breakdown of financial information relating to labor cost is as follow. Direct labor total hours 4,750 hours, total cost 33,725. Any questions if anyone is there? Okay, so rate variances, actual hours, and actual hours, standard hours. So unfavorable favorable variances, 33,725 minus 33,255 should be 475. So actual hours here, efficiency variances, favorable variances is 350. It's a debt, everybody knows about debt. Debt is something which has to be repaid according to Arnold 1998. Short and medium term debts can be short and medium term, or short term loans or long term debts or long term loans. So, for example, mortgage. Short term, medium term debt finance. So, trade credit, bank credit facilities, bank loans, debt for factoring, invoice discounting, hire purchase. We discussed other day, hire purchase and leasing as well. Trade credit finance obtained from supplies of goods and services over a period between delivery of good and the subsequent settlement of account by receipts. Bank credit facilities. Anybody can tell me about bank credit facilities? Okay, so overdraft facility for a period of time can be short term or long term. Then he's talking about bank loans, which are normally for 5 to 7 years finance obtained from the banks. Debt factorings, raising immediate cash based on the security of the company's debtors, thus accelerating payments from customers. So invoice discounting, purchase of selecting invoices, advance immediate cash up to 80% of the face value. Then hire purchase, we talk about other in our last lecture as well, is basically allows business to acquire assets by making regular payments. So, but ownership of the asset is transferred to the business at the end of the payment period. Then leasing, similar to obviously leasing allows businesses to acquire assets by making regular payments over a specified period. So this option is useful for acquiring assets without large upfront cost. Complete activity on short-term debt finance. In what circumstances which each of the source of financing be most appropriate? You can check. Characteristics of long-term capital. Over 10 years, but not more than 30 years, lender or creditor whose debts are subject to specific payments dates lenders have a no control over borrowers other than the loan agreement. So long-term debts finance, in long-term, like a mortgage can be up to 25 years, then term loan could be 5 years plus, bonds, debentures, convertible loan stock, and sales and lease bank. So mortgages obtain the security of a specific property, repay the loan by installments at a rate of interest, fixed or variable, arrangement fee, percentage of loan, and trustee is appointed at watch over the rights of the lender. Any questions so far, if anyone is there? Okay, so next is term loan. Term loans are short-term loans offered to businesses by capital expenditure and expansions, among others. So they are generally having a tenure up to 96 months. Next one is bonds. Anybody can tell me about bonds? If somebody is there. Okay, bonds are issued by government and corporations when they want to raise money. So by buying a bond, you are giving the issuer a loan and they agree to pay you back the face value of the loan on a specific date and pay you periodic interest payments along the way. So it's usually, once or twice a year. Next one is debenture. So anybody can tell me about debenture, what the debenture is? Okay, a debenture is again a loan agreement in writing between a borrower and lender that is registered at company's house. So it gives the lender security over the borrowing assets. Typically, a debenture is used by bank. So risk reduction restrictions, limit of further debts, dividend level, limit on the disposal of assets or financial ratios. Anybody knows about convertible stock, convertible loan stock? Anyone, if anyone is there? Okay, so loans which may be converted into shares at a later date. So basically, a company will usually pay interest on its convertible debts at a rate of between 4% and 8% per annum. So the example, that, for example, a company needs a convertible loan for 500,000 pounds. If this loan has a warrant of 20%, the investor will gain a percentage of the note in addition to the original 500,000 pounds. Then he is talking about sales and lease back. So sales and lease back, essentially a sale and lease back is where a company sells a commercial property which they own and occupy to a third party who then agrees to simultaneously lease the property back to the company on completion of the transfer. So they can remain in the property. So here is again activity. So it's a short activity which is about advantages or disadvantages of debt finance. So anybody can, if anyone is there, anybody can tell me about what is advantages and disadvantages. Okay. Advantages and disadvantages, there are many. That first of all, one's major advantage of debt finance is that you will not be giving up ownership of the business. When they take out of a loan from a financial institutions or alternative lender, you are obliged to make the payment on time for the life uh, of the loan. So also there are tax deduction. It's a very another advantage of debt financing is the tax deductions classified as a business expense. The principal and interest payment on the debt may be a deduction from your business income. Then low interest rate are available. Then you will be established and building business credit. So that can, fuel growth. Debt financing can save a small business big money, so etc. So also, what are the disadvantages? Qualifying can be difficult. To get a debt finance eligibility requirement vary among lender, but generally you need to have a strong credit history, make a revenue threshold, and be operational for a minimum number of years. A higher rate and a higher rate of interest then impact your credit rating. You will need collateral and then need funding for your the businesses. So this is another if you decide extra funds can take your business to the next level, it is very important to examine the advantages and disadvantages of financing. Equity is very simple definition. Equity is a contribution to a company by its shareholders. Then key features of equity capital, there are no fixed charges, no repayments in required. Directors have greater control over the amount and timing. Share in listed companies can easily be disposed of. Key features of equity capital, key features of equity capital against a public issue is quite expensive. Issuing new shares of near shareholders dilutes control. Dividends are not deductible. A higher proportion of equity can increase the overall cost of capital. Equity finance, reverse venture capital, private placing, alternative investment market, quoted companies. Here is a talking about reserves, internal finance, including retained profit, providing the main source of new capital of companies, less costly, issuing shares, free source of finance, and far more attractive than loans. So next is capital venture. What is capital venture? Capital venture is a form of investment for early stage innovative business with strong growth potential. So early stage investment is called venture capital venture. So next one is private placing. Private placing basically is a funds around of securities which are sold not through a public offering, but rather through a private offering, mostly to a small number of chosen investors. So next one is alternative investment market. So alternative investment markets is basically specialized unit for the London Stock Exchange, catering a small, more risk companies. So alternative investment market provides a market for the shares of companies that are too young or too small to qualify for benefits from a full listings. So Anybody can tell me about, he's talking about now quoted companies. So anybody can tell me what is quoted company? So quoted company means a company who has its equity shares capital officially listed on a particular stock exchange. So some of popular quoted companies are, I give you example, Amazon, Microsoft, Apple, or PayPal. Here again is activity is talking about advantages and disadvantages of equity finance. You can go through the your if you want to, you can go through that search in the Google, and you can check equity finance and make some notes. So what criteria does a company have to trade on alternative investment markets, London Stock Exchange? What is the process of obtaining a quotation on the London Stock Exchange? This is activity for you as well. After you can try to solve this out. So variances analysis quiz. Here is a quiz. I don't think so I can open because need obviously yes. This needs login and password, so you can check it out anyway. If you go online and copy and paste, you can see that quiz online here. Equity finance, then reverser. Sorry, key feature of the equity for there are fixed charges, no payment is required, directors have greater control over the amount and timing, and share is listed companies can easily be disposed of. The key feature of equity capital against public issue is expensive. Already, we've done that. Equity finance, as I explained you here, quoted companies listed in registered with the stock exchange. Advantages and disadvantages. So that's it for today. If you have any questions, please drop me an email at yasir@ukversity.co.uk. So that's it for today. This was our lecture 4 for finance for managers, and next one is your assignments. So we will discuss which we'll discuss in our in next week. So thank you very much for today's session. So if you have any questions, you can drop me an email, and you can also start working on your assignments. So have a good evening, everyone, and bye for now.